Welcome to Wolf Financial Live. I'm your host, Gav Blacksburg, here today with the one, the only Adam Patty back on for another amazing show. And of course, Sam Badawi joining me on this one as well. Host of the Sol Report from the Wolf Channel. Excited to be doing a show together. Adam, how are you doing today?
I am doing great. Psyched to be back. It's been a while, so this is a lot of fun, and thanks for having me on.
Absolutely. A lot has happened in the market. Sam, how about you?
I mean, a lot is definitely happening in the market as we're seeing today. I know some people are going to be watching the recording likely. Today's going to be a great day to remember. We'll see what happens later on today with Micron reporting.
Yeah. Can Micron save the market is the question. And we'll talk a little bit about that. It's inside of AIS, your AI Supercycle ETF. Adam, real quick, for those that don't know, so your firm is now managing about $850 million. You're constantly on TV, talking things on the timeline. People are comparing you. They're saying, is Adam Patty the next Buffett? Adam, give us just a quick intro, a little bit about you for those that are watching.
Oh yeah, I'm definitely not the next Buffett, but I'll bet if they want to tweet about that, I'll take it. Make me feel good about myself. So yeah, I've been in the ETF market since 2002. I started a company in 2006 called Index IQ, sold it to New York Life, built out their ETF platform for a few years, started VistaShares about 18 months ago. I partnered with this guy named John McNeil, who was former president of Tesla. He's on the board of General Motors. He's vice chair of their autonomous vehicle subsidiary. He's a guru, a brilliant guy, and very accomplished in building businesses. So, we set out to build VistaShares as, hopefully something that can create, products that mean something. Nothing, no Me Too products that fill white space, that offer value for investors, and hopefully, where we don't overpromise and underdeliver. That's the key for everything. So everything we do is institutional quality. We have a guy named Professor Robert Whitelaw on our investment committee, who's a former dean of NYU Stern School of Business. Everything we do is built from an institutional point of view, but hopefully in a way that makes it understandable for novice investors straight up to the experts, and that's really important.
Yeah, a lot of smart strategies, super targeted thematic strategies, right? At Picks and Shovels plays in a couple of the different super cycle areas. And then these, strategies that have really caught fire, I would say as well, with income and a target income amount overlaid on top of a more straightforward strategy as well for people. So I think that you're kind of taking two roads that are, not super well traveled in the past, but are becoming kind of mainstream.
Yeah, I mean, what we're trying to do is create different types of products that perform differently in different market cycles. We want to have something for your portfolio when the market's going straight up, when it's going straight down, and when it's in the middle. So we think we like the income space a lot, but we want to be creative there and offer value. And then on the growth equity side, yeah, our Supercycle ETFs, there's nothing like them. I mean, there are a ton of AI ETFs out there, if you want to call them that. If you look at ours, we could talk about it. It's very different. Or our Electrification product, we have others coming as well. So, we're trying to, again, add value and, do it differently. And when you compare our portfolios to some of the other products in the market, you immediately see, wow, you're getting an exposure you don't have with VistaShares ETFs. And that's what we're trying to do. It's for diversification.
Beautiful. Wow. Sam, thanks for joining me on this today. Love the solid report. Everybody should give that a watch. As we go to get started here, quick compliance voiceover, since we are talking about publicly traded products. Investors, please be careful and carefully consider a fund's investment objectives, risk, charges, and expenses prior to investing. A fund's prospectus and the summary prospectus contain this and other information about all of the VistaShares products, and they are very easy to find. You can go to obtain the fund's prospectus or summary prospectus right to VistaShares.com. There's a drop down of ETFs on each ETF page. It says prospectus, summary prospectus, very easy to find. And those should be read carefully prior to investing. And of course, we don't make investing recommendations or endorsements on the show, but we are going to simply dig in and uncover all of the best information for the people watching. And we're going to kick things off with the latest product from the VistaShares suite, and that is SIOO. That is a VistaShares Target 15 S&P 100 distribution ETF, which I think is a very interesting concept. So right now, you kind of have the two mainstays of the market, the S&P 500 and the QQQ, right? And QQQs are a little bit more targeted because there's 100 names in there, right? That NASDAQ top 100, and there's not like a ton of very, there's not like a prominent, super popular S&P 100, but arguably, when you look at it, that would probably outperform, right? If you were going to do some type of back test here versus the 500, especially in recent years when large mega cap tech has continued to basically pull the indexes up higher and higher and become a bigger percentage of it. And so I actually be curious to see what the overlaying differences are, but to be able to have that, that long-term capital appreciation and then combine it with the target income, which you very successfully have provided, month after month, people can look at the track record now, 18 months, and I guess a little bit shorter because when it was Omaha was launched, I believe is the first one, but still people can look back and see the payouts. So talk to us a little bit about kind of the thought process that went into this and, how you want retail to go about and think about this and research it.
Sure. So if you look at the S&P 500 or the NAS or the Qs, right? So people use those as core exposures. They think they're diversified. They own both of them, right? Guess what? You're not diversified at all. So, if you look at the S&P 500, the top 10 holdings are, the mega cap tech, right? And it's about 45% of the total exposure of the S&P 500. Let's call it 40 just to be conservative. Then you look at the Qs, top 10 holdings are almost identical to the S&P 500. And there you're getting, I think it's 50% or 55% of your overall exposure in those top 10 holdings. So if you own both, you're basically owning the top 10 holdings. That's what you own. That's where the performance is coming from. That's where your exposure is. So, we were trying to figure out, is there a better way to do it? We looked at the S&P 500, and I can go on a rant about the S&P 500. It won't matter because it's the leader. It's the most important product in the world, right? But it was never developed as a investment vehicle. It was developed in the 1930s as a market indicator. So, when you look at the exposures that the 500 is, the top 100 is over 70% of the exposure of the entire 500. So, and if you look at where the performance attribution, if you look at it, if you run the numbers, you will see that most of the performance, as you mentioned, is coming from not only the top 100, but certainly the top 10. And that's just a fact. So we said, well, all right, well, we'd like to get into this kind of core area, which is dominated by S&P 500 funds. And, how can we do it again in a unique way to try to add some value? So, we scanned through all the products, of course. We determined, we did our analysis, and there are no S&P 500 income funds in the marketplace. All right, that's good. Number two, with the 100, you're getting 75% of the total exposure of the S&P 500. And you're not getting all the drag from the kind of the bottom 400 or at least the bottom 200 of companies that, they're in the 500, but should they be owned? I don't know. I mean, maybe not. Then what we try to differentiate ourselves by saying, okay, what are the average yields that these income products are providing on the S&P 500 products? And, typically they're in the 8 to 12% range. All right. So we'll slide it into our target 15 strategy. And there we go. We have a differentiator on the income. Then we say, well, that's not enough. Let's try to come down and be price sensitive. So we looked at all the kind of expense ratios of the 500 products, and we came in below almost all of them. We're at 59 bips, which, again, if you're paying 68, 59 is better than 68. You're getting 3% more income as well if you own some of these products that are 12%. So unique exposure. But not a big difference from your 500. So if you own the 500, owning the 100 isn't a big step away from what you own today. I'd argue it's superior, certainly in terms of historical performance, and cheaper with more yield.
Very interesting. Sam, curious if you've had a chance to dig a little bit into this. Maybe any questions that you'd have.
Yeah, I took a look at some of these holdings here. I mean, obviously, with S&P 500 weighted, it's very heavily weighted with tech. In fact, a lot of the mega caps that are out there is approximately like 40 to 50% of the entire index. So, if you're seeing tech, which overall for the long term, I mean, we are a global economy that is just becoming more advanced in technology, AI, semiconductors, computers, whatever it is. It's going to be much more demanding in the future. So it makes a lot of sense to continue to be invested in the S&P 500. I know a lot of people who they just buy VOO all the time, VOO, but obviously they're not able to get that additional factor of the target 15 that you guys are shooting for on an annual basis. So that's like 1.25 every single month about, which is really good to see. And it's not like a lot of like some people, they like to employ with some of those covered call strategies where they get a bit aggressive with it. So like they're sitting like underwater on gains if they're selling those calls. when last April, when the market was down like 23%. At least this, you have obviously the professionals managing the ETF out there for the holders. But on top of that, I mean, the top 100, considering that's 73% of pretty much the entire index, I think that's pretty reasonable. I even looked at some of the holdings here. You have a lot of financials in there as well. And I mean, if you look at the market today, if you're sitting in NVIDIA, if you're sitting in a lot of the semiconductor stocks, tech stocks, you're feeling a little bit of the pain today, and especially in the last few weeks. But if you're sitting in JPM or XLF or some of the utilities companies and so on, you're pretty much near all-time highs. I mean, XLF is trading near its all-time highs right now.
Yep.
So I don't think this is like a broad sell-off, in my opinion, for the market. I think it's just a bit of rotation. You're going to be getting that flavor with your ETF by having holdings like JP Morgan, Next Year Energy, or Bank of America, and so on. Even some healthcare companies too. People forget that, like, look, United Healthcare might not be $500, $600 a share, but it certainly is one of the largest companies in the world and certainly part of the top 100. And you have the additional tech exposure, of course, being that NVIDIA, Microsoft are the largest companies in the entire world. They're going to be in here. But yeah, I mean, I guess for me, I've never really found the value of just going ahead and investing in the S&P 500 the VOO for myself, because my time horizon is pretty long term. And when you think about some of these ETF, you're getting the top 100 and most likely the best performing stocks in the S&P 500. And if you think about other companies that will be added to S&P 500, you just saw Robinhood get added recently. You saw Palantir, Apple 11. These are the best companies that get added in there. So with your ETF SIOO, are you guys adjusting your ETF for rebalancing based on what the S&P 500 does within their index, like immediately when it happens, or is this like a quarterly thing you guys do?
So, and just to your earlier point, so right, the S&P 100 are the blue chips. It's known as the blue chip index. That's what it is. It's the blue chip company. So, in terms of a flight to quality, quality, this is the quality, right? You're missing all the others. So, kind of down the cap spectrum, down in the 400, 300 to 500 range, those companies. But so when do we, when S&P, we could do it monthly. It's inactive. We're the core of our strategy is an index-based strategy. So we license the S&P 100 from S&P. And when they make a change, we can make a change. So if they're doing it quarterly, we're doing it quarterly. So we're just following exactly, what the S&P 100 is per the Standard & Poor's investment committee. That's as simple as that. So if Palantir makes it into the 100, it's in our product.
So is that less so based on daily moves that increase market cap size to put something in the 100, and more so based on their committee decision?
Correct. Well, once it's in the S&P 500, then it's market cap weighted, right? The top market cap weighted companies by market cap, weighted by market cap, are in the 100. So if that changes, so let's say XYZ company comes in at number 498, but by the next quarter it's at 98 because it's gone up, it'll be in the 100. So I mean, that's all market cap based, performance. Companies making it into the 500 is a decision by the S&P investment committee.
That makes sense. I was looking right now, just a question for those that are maybe looking at this on like a daily basis right now, because probably the first thing people do is they say, all right, let me go look at SIOO and let me go look at SPY. And so on a day like today right now, SIOO is down 0.28%, SPY is down like 0.75%, and or actually worse, down 0.91%. So is that due to, thin trading? Is it due to something else, or is it just, hey, the 100 are just holding up better today than the 500?
Yeah, I mean, today it is thin. Yesterday was much more robust. I don't think there's much buying going on in the market today. But no, it just traded. I mean, it just ticked at 218. So the 100 is outperforming the 500 today.
Interesting. Do you have any data for those, or I guess should people just kind of go back test on the 100 versus 500? I'm just kind of curious.
Oh, absolutely. I mean, it's an index. It has decades of historical data. So you can do an analysis of the 100 versus the 500, or you can look at the index, right? The OEX versus the SPX.
Got it. That makes sense. Yeah.
Now, of course, please, you got to note, of course, this is an option strategy. So an option strategy is going to perform a little bit differently than just a straight index, right? So the options provide a drag. When the market's going straight up, you're not going to get all of the upside of the index because we have that 15% income, overlay on top of it.
So maybe even more so then if people right now are saying, "Hey, we have some uncertainty," and they're having a rush to, blue chip, names like that. Also, they want some stability. This might appeal to people in multiple ways.
I think so. And that's kind of why we waited to launch it. We were going to launch it several weeks ago, but then the market got rocky. We wanted to see a little bit of drawdown in the S&P before we brought it out to give people a nice entry point. But yeah, in rocky markets, flight to quality, flight to the blue chips. And that's what this is. This is a blue chip index. That's what it's called.
Very interesting. I know there's a few other things I want to touch on. Sam, first, any follow-up, any comments there?
Yeah. What's the percentage of the SP 100 that's invested in financials and healthcare right now in your estimation?
Great question. And I don't know off the top of my head. I wonder if it's on our fact sheet. That would be helpful if it was. No, of course it's not. It isn't. We should have that. But I can look that up though while we're talking. I mean,
I would say it's probably somewhere like 15 to 20%, maybe even a little bit more than that. And if you think about what's going to happen in 2026, if the market is actually setting up for that, financials and healthcare might actually have a really good year next year. Obviously, we're closing the year near all-time highs for those. We'll see what happens with the AI trade. I mean, these tech stocks are just extremely volatile, and they're definitely going to have a weighting on the OEX or the SIOO. But there's the AI trade is not over. I don't think it's over. I think fundamentally everything is still sound, with the exception of certain companies out there. But I do think given the long-term perspective in the market, like if we're thinking about maybe like the next few months or in the next year, it's like, who knows what's going to happen at that point, right? Like, who knows how the market's going to react the next couple of months or the next week or even today? Like, who knows how the market's going to react? But if you think of it from the long-term perspective, especially from an inactive standpoint, people buy the market every other week in their paycheck, religiously for a reason, because they're not going to need that money for a long time, but also they want to participate in the S&P 500. I mean, it's basically the market has basically doubled in the last 5 years, right? And that's not going to happen all the time, right? You're going to have peaks and troughs. You're going to have ups and downs, ebbs and flows, but I'm always a proponent that unless you want to like individually manage a stock portfolio, which is a very hard thing to do, and which is the reason why they put you in those jobs and everyone else in those jobs, is because outperforming the market is just very difficult. Yeah, did you take a look at the performance of the OEX versus the SP 500?
Yeah. I was looking at OEX, OEF. Is that the one that you're mentioning, right? The 100 SP 100 index fund.
oh yeah, that's an iShares product. Yep.
Yeah,
And
sure. So
it is around 12%, by the way. 12% financials.
Oh, okay. That's pretty good, decent amount, especially if that starts to balance itself higher if tech stocks do underperform. Go ahead, Gav. Sorry.
Yeah, so OEF timeframes year to date 16%, 1 year 13.66, 5 years 99 percent up, 99.6. Compare it to SPY. SPY is up 82.5% in the last 5 years, so it is being outperformed by roughly 17%. SPY is up 14% year to date, so it is outperforming that by about a percent, and SPY is up 11.3% last 52 weeks. So it is outperforming on every single time frame.
That's good. That's good. Hey, look up, add XLK to that performance chart as well. And then check out XL. Well, probably not XLY. That's a lot of consumer discretionary, but XLK would be like your Nvidias, Apples,
Right.
Microsofts. That's like 50% of that ETF.
XLK outperforming on every time frame.
Yeah.
Kind of similar to OEF on the 1 year, but outperforming certainly on the 5 years up 124% and
Yeah.
year to date 19.2%.
So then you're going to get that outperformance most likely, I would say, as far as SPY goes. If we do have an uncertain next couple of months, I would think that healthcare and financials are going to be outperforming tech. So you would not be including that drawdown. And on top of that, you have the options target income of 1.25% per month. It's 15% per year. I mean, if that's something that someone might be interested in, again, this is not financial advice. It's just, stay invested in the market. I'm never a proponent for timing certain things with the entire portfolio, but this does make like a pretty attractive product when you think about getting a taste of alpha, getting a taste of the 15% a year, but also being part of the blue chips, which I mean, it's looking pretty good for UNH, JP Morgan, Bank of America. We'll continue to see.
So to your point, the options overlay. So in a raging bull market, an option strategy will not keep up, right? So I always tell people expect around 75% of the upside.
Okay.
But when the market's rocky or going down, you're getting a little bit of a buffer on the downside. So I tell people to expect around 85% of the downside. So, so having that income strategy it's a nice diversifier, right? I wouldn't say you don't use an income strategy as your entire core of your equity portfolio, but it's a nice diversifier. So you own the S&P 500, you own VOO, for instance, you use this, as your core income strategy, and you're getting the same exposure pretty much, but you're getting that 15%, which is important. And to your earlier point, also, we are very data driven on the option strategy. We're not looking to maximize income, as you mentioned, Sam, earlier, which is important. So we're not trying to make 126 or 127 a month. We're trying to make 125. Once we make that 125, we're pulling out of those positions. So we think that's important as well, because, we're not cowboys, waking up in the mornings. How do we maximize this? How do we maximize that? We're just hitting our targets, very methodically and in a rules-based way, which I think is important. And it gives investors, hopefully, the ability to understand what they're going to get. Now, I'm not going to guarantee we're always going to hit the 125. You never know. We have to date on all of our other products, but, things happen. Could hit, could miss it. But, hopefully over a year, we'll hit that 15%.
I'm wondering, so let's say hypothetically, and like this is very short term. This is just me with my crazy hypothetical mindset sometimes. I always try to just play out certain scenarios in my head. Let's say, okay, you guys start this today, and let's say the market either is flat or continues to draw down for the next 3 weeks, right? Or 2 weeks. And then the ETF or whatever you guys are managing, you hit that 1.25 already. So you guys cover all of your covered call positions. And then you already got 85% of the drawdown, whatever drawdown happened. Does that mean if the market hypothetically rallies 1% from there, you're getting 100% of that upside in the remaining for that month, for the month?
There's a lot of math in there. I'd have to really. No, I mean, I think it's on a day-to-day basis, right? So, I mean, if the market goes up 1% in a day, we likely we won't get to the 1%, and or it could be a week or a month or whatever it is, right? I'm just saying on an individual move over time, right? So if the market's up 10%, we should be up 7.5% generally. Whether that's a day, a month, or a year. Over time, it evens out also, because there is gyrations in the market. ETFs trade differently depending on, what the trading volume, the volatility looks like on a daily basis. So, but generally over time, 75% of the upside, 85% of the downside, which, I think is, look, I mean, hopefully we'll do better than that on the upside, but I just don't want to overpromise. But we do want to avoid any NAV erosion as well. So we do, we're very careful with our option strategy. We're selling covered calls. We're selling actually OEX on this product. I misspoke. So investors will get that 60-40 treatment of short and long-term capital gains, which I think is attractive. I don't push that as a selling point. A lot of the providers talk about it all the time. Whatever. Everyone's tax issues are different. So, I don't really like to get into that. Just look at the total return. That's bottom line. To look at the total return. And if it's doing what you expect it to do, it's a winner. If it doesn't, it's not.
Yeah, I think that's pretty fair. I know that there's a couple others I want to hit on here. Any other comments on SIOO that you want to go over? It seems to me like probably pretty perfect timing for the launch, for something that, you're looking to, what's the goal? Outperform SPY, right?
Yeah. Well, we want to provide the exposure of the 100 with the 15%. If we outperform SPY, I mean, that's the goal. That's why we launched this. But, look, the SPY could outperform in different market conditions too. What if we go into a, 100% small cap driven market or mid cap driven market?
Right.
Then, the other 400 will probably outperform the mega caps to some extent. But over time,
with the amount of CapEx that the top 100 are spending, do you think that's not my vision right now of what the next years look like?
I agree. I mean, look, I think if you want that outperformance, you look at a product like POW or AIS, more thematic, trying to get exposure to certain segments. But yeah, I mean, look, the top 10 holdings are the top 100 are all the blue chips. But if you look at those top 10 holdings, those are the companies people want to own. And, even if I talk about people rotating out and being more into a value driven market, sounds great. But the bottom line is that the market's being driven by these big tech companies.
Definitely, definitely. So, you're speaking of POW there. That's one that I want to rotate over to. I also wanted to show you something that I thought was kind of cool. So, somebody sent me, I don't know if you guys have ever heard of a stock cube. So, this guy sent me, it showed him my background, and he sent me this light up cube that has, all right, I get this on my camera. It's got the Wolf logo on one side, and then I can add like stocks and ETFs onto the other sides, and it provides like live updates. So
That's
I've
awesome.
got some of your I've got some of your tickers on
Nice.
here now, so I can get my live like POW updates as
God.
they're coming through, and this just like sits on the desk. So I was trying to time it up there to see if I could get it to have
That's cool.
POW on the screen.
Hopefully that's not sitting in front of the picture of you and wifey. You don't want you don't want to block that picture on the desk.
Yeah, something like that. I don't know, but this is just gonna sit in the background. Here we go. Here we go. All right. So as you can see now, everybody, I've got POW
Look
on
at
the
that.
stock cube with the real-time performance in
Down
the back.
4% today. It's on sale.
I know. But anyways, that's just kind of sitting on my desk these
Pretty
days.
accurate too. That I saw
Yeah.
Palantir and there I looked it up. I was like, okay, that's pretty accurate. Where's he
Yeah.
grabbing that feed? Who built that API?
Yeah.
Shit, I don't know. They have a whole cool thing how you like set it up and everything. But anyways, I just thought it was pretty neat, and so I went ahead and just put that on.
That's awesome.
With that being said, and that's for anyone that's on the live stream. I was grabbing it from over there. That's what I was doing there. Let's talk POW. So POW is one that excites me, and I always disclose this on any streams because obviously we work together. But I did personally invest in POW. It's something that I can relate to. Like one of my first jobs was selling gas and electric. I'm very aware of the cost of these things and how they continue to go up, and it's just coincided so nicely with this move in AI to like, hey, to understand like the next step is to understand power and demand for power and how that's going to continue to go. So it's been an interesting market, so far for power. It hasn't had a ton of time to be out just yet. It's kind of, for the most part, kind of chopped to the right at this time period. But the names that are in it are really exciting. And you came onto, one of our spaces to discuss this, and we had people like Jaguar on there, and Jaguar's like, if you're going to invest in, this, you need Quantra. And you're like, well, it's our, top 7 holding, right? And Stock Talk's like, well, if you're going to invest in this, like you need this. And you're like, that's our top 4 holding. Right. And you're just like naming these names. And so I think it was just super, super well thought through. I haven't had a chance to ask Sam yet, kind of his thoughts on power. We haven't really discussion around this. Sam, have you looked into this power and energy area?
So Stock Talk mentioned this. He always joins the Stocks and Spaces with the crew, and I was looking at the holdings here, and I'm just thinking about like if at the beginning of the year you put all of your money in GE Vernova or GEV, you would have quadrupled your money this year because GEV or GE Vernova, which is basically a nuclear supplier, and one of the profitable ones too. Not like the Oklos or anything, not the speculative stuff. The stock has just been going straight up, and you have this in your ETF too. And if people need to just understand, right, a lot of the capex that gets put out there, it doesn't just go toward chips. It goes toward the whole build out of a bunch of data centers and the entire AI stack. Whether it's software, but a lot of it is hardware. But also a portion of that is buying the land or leasing the land, the buildings, and everything. And on top of that, you need to make sure you have enough power that you purchase today for the next 5 or 10 years, because power is going to get more expensive. If you look on the scale, I don't even need to look on the scale. I just need to look at my electricity bill in California. I live in Los Angeles. It is just going up every single year. Like I don't, if inflation drops or if we get deflation, like I'm pretty sure the power bill is still going to go up. So these companies are locking in that electricity ahead of time, and which makes a lot of sense, right? Because I don't know. I can't really think of any numbers off the top of my head per kilowatt hour. But if the demand for power, yeah, like you said, the demand for power is going the same with AI. Like if that is what, if you believe in AI, you believe in semiconductors, you believe in the additional capex that's being spent. I think it's like projected to be about $400 billion, $500 billion of capex from the hyperscalers alone by 2030. You're going to need that power. And from what I hear, there's already some power issues in New Jersey because they don't have enough juice to feed all these data centers that are very high in demand for the amount of compute they're driving, in addition to the residential power. Now, I don't know if I'd want to live in New Jersey if that was going to happen, but like they're certainly not going to sit back and let this happen, right? The government, with all the financing and everything, they're going to be taking on a lot of these companies. This is one of the reasons why you see GE Vernova, which is one of the top holdings on here. In addition to that, I see other holdings in there, Hubel, and then you have Prisium. Almost all of these stocks are up a lot year to date. Mm-hmm. And then is there a 15% target or for this one or no?
Nope. Just pure growth.
Okay. Yeah, you don't really need it. I mean, if you look at AIS, for example, AIS is another ETF. We don't have to dig into that one, but that's another ETF that's focused on the picks and shelves today. And I mentioned Micron's reporting today. That's up like 48% year to date. Mm-hmm. The Qs aren't even up that much year to date. The Qs are up like, I think today it's probably like 13, 14%. And you have the picks and shovels, which has really been the driving move of this entire wave of AI, right? Everyone's looking at NVIDIA, everyone's looking at other stocks, whatever, but like power and semiconductors and picks and shovels is really what's going to benefit the most off of this, no matter what. Because let's say someone already booked like $5 billion of electricity for the next 5 years. If to break that contract, they're going to have to pay up for part of it already. And these companies already locked in that deal, and they're going to be getting that expected revenue, which is the reason why you've seen the appreciation in a lot of those stocks that are happening. But you don't have any speculative companies out here. You don't have Nano Nuclear in here. You don't have Oklo. You don't have SMR in here. You have companies that are actually bringing in profits today and have tangible revenues today versus the speculative stuff. So I think this is going to perform pretty well for the next few years.
Yeah, I mean, look, we're following the CapEx. It's very simple. And this is, John McNeil, my partner, this is his brainchild. It's all about the bill of materials, So when Meta says they're going to invest $100 billion in AI, what does that mean? They're going to invest in data centers and semiconductors. Well, okay, great. What does that mean? Then you got to look at what goes into building out a data center. It's cooling systems, it's cabling, it's racks, it's switching, it's all that boring stuff that, of companies, most of the companies you never even heard of that are, soaking up all that CapEx. So that's where the profits are. That's where the profit margins are. That's why AIS focuses on that part of the infrastructure, right? Data center and semiconductors. POW is the bookend. So everyone's been talking about AI data center infrastructure now for a year, 2 years, but it's only really recently they've been talking about the energy infrastructure. So, we don't have an energy problem in the United States. We have a power problem. And what that means is, the power grid hasn't been upgraded in most parts of the country for 30, 40 years. There's hundreds of
definitely not here in Puerto Rico. I'll tell you that.
Yeah, well, it goes out there constantly. But look at California, right? I mean, there's brownouts all summer just because of consumer demand in electric cars. And, they want everyone to have an electric car by 2030 or whatever it is. I mean, the grid can never handle it.
I think they pulled back on that because that expectation was a little wild. Wild. That you see what I did there? It was a little wild.
Yeah, I love it. Little plug. So, so what POW is, it's very simple. It's just like AIS, same exact process. But here we're looking at where the CapEx goes into building out the grid. So when people talk about energy and power, a lot of them are talking about solar and nuclear and all these different things. And yes, those are important. Okay. And I'm not saying they're not. And we have some of that. But if you look at where the CapEx spending is, and we have a slide somewhere, I don't know what number it is down the deck somewhere, but let's see where it is. Might be a little further.
Power demand.
You go down.
Trillions in CapEx?
No, there's a lot of money going into it. Yeah, that one. Is that? Yeah, CapEx. So, and I can't really read it, but it's fine. So,
I can get you a little closer.
No, it's fine. It doesn't matter. I'm blind. Renewable.
Now with the ETF, hopefully not you're blind with the ETF.
No, I'm blind. I'm wearing like Amazon $5 readers. I'm like an old man now. So the CapEx is going into transmission and distribution. That's about 50%. That's that big purple bar right in the middle. So, when people talk about building out the grid and upgrading our energy infrastructure, it's not about necessarily all about solar. That's a piece of it. And there it is. I think it's one of the blue segments, kind of the renewables. but it's the boring stuff in the middle. It's the switching equipment, it's the cabling, it's all that stuff that you need to, the transformers. That's the biggest problem in power now is, when people look out their door and they have those big poles outside their door and they have those big, transmission boxes of transformers on the top of their pole. Believe it or not, that's the gating issue right there to our grid. It's getting those upgraded and new technology and getting the cabling to these new systems. So so POW is simply following the CapEx. So about 50% of our exposure is going to be in that distribution and transmission segment, and these companies like Prysmian, which is huge. And a lot of these companies are not U.S. companies. These are local securities in Italy, South Korea, Germany, and so forth. So these are exposures that most investors can't even get access to. They can't buy the single stocks locally. So we're providing that in an ETF. So it's a very unique exposure.
This is a bit of an out there question, but Elon Musk has made it pretty clear, Satya Nadella, others, that they want to build data centers in outer space. Now, I don't know how feasible this is, but are you not basically like quadrupling the amount of power needed because now you need to send a rocket to space with materials and build? Like, I'm just like curious. Like, I don't know if you've looked into this at all, but it seems like this would be a massively the key constraint here would be power probably to get it, because they got the rockets, they got the materials.
Well, it's funny. We were at a conference last week. My wife runs these really good financial services conferences, and John McNeil gave the keynote, and he talked about this. He talked about how these data centers are that Musk wants to put into space, into orbit, are refrigerator size. So it's really getting these up into low Earth orbit and getting enough of them out there, and then having the solar energy run them. And in terms of the economics of that, I don't know the answer to that. John would definitely know that. I don't, but I'm sure Musk is figuring that part out.
Okay, funky follow-up question on there, because there's a company that's IPOing tomorrow under the ticker FJET, and they're basically focused on rapid delivery of small payload satellites to low Earth orbit. And so clearly people are building in that area. Do you think that you're going to have, like, because obviously you have a lot of picks and shovels plays in here. Do you think like there's going to be things in that thematic of shooting things into space that'll like make their way into any of your ETFs?
Yeah, I mean, when they become important, and if the CapEx is being deployed there, they will be in either one of our AI or powered or electrification ETFs. But we have others coming as well that might soak that up a lot easier.
So then let's talk here for a second. So what puts Hubble at number one at the moment here in regards to the weighting pieces? Is it the one that gets the most CapEx? Like, what's the
right? So the way we do this and AIS is the same. We analyze the supply chain first, right? So we go down in this case, we look at the power, the grid supply chain. What are all the different components of the supply chain? Then we overlay the bill of materials, saying, okay, well, if you're going to upgrade the grid in all the different components of that, where are the most dollars being deployed? That makes it a more important piece of the supply chain, clearly, right? So, and then we identify the companies that slot into each one of those segments. And Hubble is in that kind of distribution. Well, I mean, they're a massive company. They do a lot of things in the energy space, but they are, extremely important in the transmission and distribution segment of the supply chain. They focus on all the switching equipment and the cabling that is required by everyone around the world if they want to do anything on the grid.
God, it makes sense. Sam, you already pointed out G Vernova. Are there any other companies in these top 10 area that really stick out to you?
Eaton sticks out. Powell Industries, that one's been doing pretty well. PWR Power, you already mentioned. Jaguar's been talking about that one. Also, Paper Gains has basically been in that one for quite. He actually told me about that one last Friday, and that was when I looked in. I was like, "Oh man, how did I miss?" Like, these are the names that Wall Street doesn't really talk about. Wall Street talks a lot about the high flying stocks that are out there, and not because it suggests people invest in them, because like those are getting the most hype, right? But I mean, if you really look for the alpha, you really want to invest very heavily in the companies that are not really talked about.
Well, exactly.
Why is this Yeah, I mean, just because it's topical because of today, but why do you guys think that this whole industry is really getting hit so hard right now? So I looked, G Veranova said this is its worst day for G Veranova since I think all the way back in January.
Hmm.
Uh, Hubble also, and Power, and it just seems like this thematic is taking a hit right now. I'm just curious if you have any thoughts why.
I mean, I think they're up pretty significantly over the last year or even more. And
For
I
sure.
think there's a flight, risk off environment right now. I mean, I think it's as simple as that. The economics haven't changed. I mean, GE Vernova, let me just give you the synopsis on that, and then you can make your decision. The economics haven't changed. So GE Vernova, the reason why that stock has done so well is because as people are building AI data centers, they've recognized there's no power, right? They need power. So if they want power, they need to build their own generation facilities on the campus with the AI data center. Most of these are natural gas driven. Who creates the turbines for natural gas? GE Vernova. They're sold out for 2 years. So they can't create any more product. So the economics of their business haven't changed.
Well, so okay, they're sold out for 2 years. Why are they not doing everything in their power to create more?
I'm sure they are. I'm sure they're trying to create more capacity, but in terms of their absolute capacity as of up 2 months ago, 3 months ago, whatever it was when that stat came out, they were capped out. So I'm sure they're scrambling to create more capacity. I mean,
Quick question. I mean, they're such different things, but like we've seen CapEx really work and continue in some places, and then other places like, the metaverse. What happened? Facebook, took a $71 billion write-off or something. Um, versus something like this, like, maybe I'll throw this to Sam first. Like, it feels like the AI thematic has a lot more staying power than some of the other things that we've seen a lot of CapEx go into. Maybe that's me personally, but, like, nobody ever really used the metaverse, for all intents and purposes. I use AI more than ever nowadays. The more you use it, the more helpful it becomes, right? I can go into there and it can become, my legal counsel, not for, final pieces. You check things with a lawyer, but like in the short term, right? It can help with saving thousands of dollars there and just giving you insights. It can create research on, if you need a deep dive onto somebody, right? All these different things. So I'm just curious, like, if you think this really has that staying power for you first, Sam.
My bad. I thought you were talking to Adam for that one. I do think it does. I mean, as Adam was saying, they're already booked and they're going to be looking to. I think the way that the stock is really positioned is that not the assumption is made that they already booked a lot of the turbines that they're building out for nat gas, but also on top of that, I think the assumption is that there will be continued bookings ahead for whatever inventory they're going to bring back on. Um, now's probably I would say like now's probably not the time to be like, oh, this is going to continue going up because I don't know how much it's up year to date so far, over like 300% or somewhere around there. So get like a little bit of a pullback here, even if it's like its worst down day. The flight to safety is when the baby gets thrown out with the bathwater, right? Like days like today is when people are probably panicking and just clearing a lot of their books, whatever it is. So they're selling everything, and if let's just say this was an equal weighted portfolio when it first got balanced out and hasn't been balanced out since the beginning of the year. These companies are going to be a pretty big holdings in the portfolio because they've amassed so much appreciation over the entire year that if they have to degross a little bit across the board, it's going to be whatever times more this position than other positions, right? And it might not be the best day for it so far, but again, you look at the year to date chart on there, it would have to drop down dramatically for that thing to reverse. Now, if today was literally the top of AI, which I don't think it is, then this is probably going to go lower. But I would argue that if it was the top of AI, everything is going to go lower. The thing is that you want to be invested in the assets that are going to have the most amount of appreciation and outperform the SP 500 over a period of time, not a year, not a couple of weeks or anything, just like over a long period of time. And if you think about it from a thematic basis, they're not just going to stop working. These companies are not going to stop spending out of nowhere. We already saw that slide from the deck that you pulled up, Adam. They're projected to spend more money through 2032. It's not going to stop. It's really not going to stop.
And they have to spend it, right? AI is an arms race globally, but the only way we can achieve any goals there is to upgrade the grid. The grid needs to be upgraded regardless, just for national security purposes. I mean, it's a disaster. So forget AI; it needs to be invested in. But it will, AI is accelerating that. But Scott, to your question about the metaverse, I mean, I think the main difference between the metaverse and all that capex that went into that was R&D. Right? The capex that's going into here are purchase orders for industrial equipment, at least in terms of AIS's exposure and POW's exposure. We're not taking flyers. This is all about purchase orders for the next 3 to 5 years for industrial equipment to build out specific projects that we are aware of, and and everyone's aware of. And frankly, let me say one more thing, and just to make it clear to the listeners is, we're not speculating on this. Any kind of investing is some type of speculation, so you got to be careful. But we have experts on board that are building data centers, that are experts in energy infrastructure. With Sonny Madra, the president of Grok, John McNeil, I mentioned, Justin Lopas, who is the head of manufacturing at Anduril, who now is a chief operating officer and co-founder of Base Power with Dell. He is Justin's one of the premier experts in energy technology around the world. And, we do our calls and they're identifying what the pipelines look like in different segments of the market. And that's how we identify our companies, whether, we take something in or put something out of the portfolio.
Yeah, it's a great point that you made there. It's not about R&D, it's about actual purchase orders. And what that means is that these companies are going to have steady revenue streams and they have predictable revenue streams, which is, I think, the most important thing, right? And so when you have predictable revenue streams, you can look at a company and say, no matter what happens with the overall market, I understand this company is going to make X amount of revenue. Ideally, they're going to be profitable, right? And so I think that becomes a great area for both upside and flight to safety. So you kind of hit on both sides. And we're really also we're kind of talking more AIS here, I guess, for those that are listening at this point, than even POW, but they go seemingly hand in hand. And for me, the thesis, I sat down, I was at the Money Show, maybe like a year ago at this point, or maybe February. And I wish that because I was talking with Mike Larson about the AI thematic, and people were like, it's funny that it was like a year ago. People were like, do you think it's over? And then like the AI thematic went up like 200% more. And they're like, all right, do you think it's over? And it's just like, you keep looking at it. And what I told them at the time was I was like, this is something that is going to save people the most valuable resource in the world. We're going to accumulate more of the most valuable resource in the world because of AI, and that is time. And like, this is just going to be a time saver over and over and over. And I said, I want to invest in the thing that creates more of the most valuable resource in the world. Mm-hmm. And, I was invested in it, but I wish I'd even I look back at that interview. I'm like, man, I wish I even just tripled down on that thesis. And so when we get to points like this, I'm like, I'm not going to be shaken. I look at it and I have confidence in this thematic because it is the right direction. So do you share that mindset?
I mean, clearly we're huge bulls. I mean, you listen to John speak, and we haven't even his quote from the conference last week was, "We're in the top of the first inning for AI," and he's not the kind of guy just to say something. He's a very serious guy. Top of the first inning in AI, so we are just getting going. I mean, all the stuff that we're seeing. And the risk is really more on the consumer facing stuff, right? So the chat GPTs and stuff like that, are those models going to be the winners, or are they going to be smaller agentic models that actually become the true value creators that work on top of a chat GPT or a Grok or whatever it is? So there's going to be a lot of change. But that's why we're focused on the picks and shovels right now. When the capital starts flowing to the consumer facing side in terms of profits, when there's profits generated, we'll add those to the portfolio. But right now, the profits are all on the infrastructure, and so we think we're well positioned. And if you look at our portfolio versus any other AI ETF out there, we had an advisor say, "Well, I own this one. Can you do an overlap analysis and a performance analysis?" First of all, performance killed it, but they were 70% overlap with the Qs. I mean, okay, great. There's no value. They were 8% overlap with us. So, we're providing a completely different exposure.
Yeah, I know we're moving to wrap up here, last couple of minutes. One thing which, we didn't touch much on today was OMAH, which has just been a consistent one right there. And people should really look, even as Berkshire for the most part, people can look at Berkshire as basically trended sideways. OMAH came out back in March, and Berkshire, really had like kind of a peak right around March. It's actually down in that time period, since right around like mid-March, it's down a few percent when you go and you look at OMAH, even though, yeah, hey, maybe it's also down, whatever it is, a few percent on the chart. But when you look at the total return, having that income, right, it's basically down the same amount on the chart, but having that income has actually boosted it into a positive total return. And
Yep.
so this is one that I just encourage people to look at. But then, kind of what happened with AIS here, where it had that initial dip, huge move, right? Bounced nicely here off that key VWAP. This is where I'm excited to, see what's going to happen with POW, because it is, such early days on it. But clearly your firm, when given time to build track record, has come out of it very, very strongly. So excites me. Love working together with you guys. Like, you actually have seriously innovative products. You have products that I want to go ahead and buy myself, and own. You have products that I want to tell my mother, this is the type of thing that you should own. So it excites me. Final minute, Adam, any final comment for us?
No, I just appreciate your time and everyone who listened in. Just, one thing I always like to say is, just don't get scared of what's going on in the market. Don't panic sell, stay the course, be disciplined. Always look under the hood of what you're buying, because just because an ETF is called something doesn't mean it's actually that exposure. To my point about the AI ETFs, I mean, just, you got to know what you own, and just be smart, disciplined, and have patience.
Yeah, and I encourage people to go in and actually do the research. One of the really cool things is that you basically put the research together for people as well. So, like, why do I tell people to go, read the summary prospectus and pieces like that? Well, of course, from a compliance perspective, it's necessary. But what's really nice about this is that just all the thesis is already put together. People can go POW, and they can go POW investment case, right? They can go over to AS. They can see, fact sheets, right, and all those different items. I'd actually love to see just more and more investment case, pieces on
Yep.
the website, because I just love that presentation.
Yeah, I don't know why our AI, I think our AIS one was updated and is going through compliance. We have a new white paper
Makes
that's
sense.
going up there as well. We have a POW white paper that's being put up there. We have a Target 15 investment case that should have been on the SIOO. The website needs, constant updates. So,
Yeah.
but, reach out if you're looking for anything. We can certainly direct you to it. And, we'll continue to add educational materials to the website.
Perfect. Sam, any final comments on this one?
No, pumped up for the earnings after hours today, man. Micron, pretty big part of the portfolio for AIS. Yeah, cross finger. I mean, you got SK Hynix, Samsung, and Micron in there. So, but those have made massive moves lately. So, portfolio on AIS, 48% year to date. Phenomenal work, man.
Yeah, I will actually then, sorry, I keep screen sharing things, but I just want to point out, like, we talked so many times on our streams together about SK Hynix, and basically said, like, hey, like, this is one that you can't even, for most people, go buy directly, in your brokerage. But when you go and you look on here, obviously the 1 day has continued to be awesome. And then when, you pull out, like, it's just held up really nice. Like, it had just a move right here, kind of to behold of 137%. And then it's basically held right here. And these are the types of setups that I love looking at. It gets even better when you go out to a year. You can see, like, hey, like, there's like a piece right here. And sometimes consolidation is just like what you need. Like this, when you zoom out, like, this was consolidation right here, and then boom, right? And so consolidation and
It
looking
wasn't it
really strong.
wasn't until June when the market realized, hey, because this is what Adam has been pointing out since our last interview about a few months ago, was the market realized, like, wait, high bandwidth memory is actually very important. It's like, yeah, it's like 40% of the bill of material for semiconductors. It's very important, and they've been priced amazingly. So that's why you saw that massive S curve.
Yep, I agree.
Yeah. Perfect. All right. That is going to do it for today's show. Thank you to everyone that tuned in. You can see all of the different ETFs from VistaShares, as well as there's prospectus, summary prospectus on the website. Easy to find. You can follow Adam Patty and the VistaShares account on X. You can follow Adam Patty at Adam Patty. You can follow VistaShares at VistaShares X. Easy to find. Make sure you're following Mr. Sam Badawi over here at Sam Solid 57, and you can follow any of the Wolf accounts for me. Any one of them is fine. Thank you, everybody. Take care. We'll see you on the next one.
Thank you.